So in this video, I want to talk about some missed opportunities I had this week and some of the trades I made this week. So since I am an option seller, I look for stocks that have high implied volatility, and I use this website here, Market Chameleon, and I go to options and then implied volatility ranking, so IVR, and then I'll filter on market cap over 30 just because that's what the website gives me, but I'd rather deal with big market caps just to make things safer. IV rank over 70 and open interest percentage over 70 as well, and then I sort by IV rank, and I saw that Amazon, Alibaba, Spotify, DocuSign, they all had high IV, and even Monday morning Tesla had high IV. So I wanted to sell something on them, either spreads or naked options. Now the big opportunity that I missed, in my opinion, that really hurt is Amazon selling a naked call on Amazon. So Amazon does not have earnings this week. It has the earnings next week, it's July 27th. But IV on Amazon was pretty high, and Amazon was trading at around 3,300 on Monday, 3,200, 3,300. And I had the chance, I was even looking at it, and I'll explain, to sell the naked call on Amazon expiring this week at a 42.70 strike. So if we go down here on the 42.70 strike, you can see that the 42.70 is trading for around 61 cents. So between 58 and 63 cents. Now, I was going to sell this option on Monday morning for $7. It was trading at around $7. I was really tempted to do it. I actually took the time to explain it to my wife just to get her point of view, explaining her the risk. Now, the risk in reality is almost zero, because the risk is any dollar amount Amazon closes above 42.70 come expiration Friday, I lose that dollar amount times 100. That's the risk. That's the real risk. But in reality, what are the chances that Amazon goes from 3,300 to over 42.70 in 4 days? Already that it has gone up a lot in the past few weeks. And in the past few weeks, and if I compare 42.70 to 3,300 about, that's almost 30%. Now, Amazon does not go up 30% in a week in the past few weeks unless it has earnings. So all these factors made the trade really, really safe. The fact that the broker here, in the money probability by the broker, tells you that there is a 99.99% chance that this trade wins. So even the broker tells you that there's a 99.99% chance this trade wins, and I still didn't make the trade. It was trading for $7. You know how sometimes you want to get into the trade, but you're a little bit hesitant. And I even sent an order, but I sent an exaggerated order. So it was trading for around $7.50, and I put an order to sell at $8 just to, if it goes through, well, at least I got a little bit more. If it doesn't, oh, well, I tried, it just didn't get filled. Like, I'm giving myself an excuse why I didn't participate in this trade. But as you could see, it would have been an amazing trade. I was going to sell it for $7 or $7.50. So that's $750. So it's 100 shares per contract. So that's $750 I would have collected. And actually, I would have closed it on the same day. And at the end of the day, Monday was trading at around $2. So I could have bought it back on Monday, end of day, and would have made a $500 profit in the same day. If I had kept it Monday and Tuesday, look, as you can see right now, it's trading for 61 cents. So would have made about almost $690 profit US. Now, the capital required to make this trade, here, if I place it right now, so the capital required to place this trade is 15,000 US. That's just the capital required. It doesn't mean that you'll lose 15,000, because the amount that you can lose is actually unknown. It's unlimited. In theory, it's unlimited, but in reality, the chances that Amazon goes above 42.70 is really unlikely. There's a 0.01% chance that it goes above 42.70 according to the broker. So if it closes, let's say at 4,300, then I lose 30 minus 7, so 23 times 100, so I lose $2,300. That's if it closes at 42.80 come this Friday, July 17. But obviously, look where it is. It's at 3,078 when it was trading at 3,300 on Monday. So I had this chance on Monday, and I didn't do it because I think what scared me really is the unknown, the fact that you never know what could happen. That 0.1%, if it goes to 5,000, which absolutely is really unlikely, but I mean, I know that anything is possible. So that scared me. And the fact that if it moves up, let's say 300 points, 400 points, so even if it's still far from a 42.70 strike, the fact that it's moving up my maintenance excess will go up. So it'll increase the capital required for this trade. And if it increases the capital required for this trade, I might not be able to stay in the trade, and then things can get ugly. I might have to close the trade. I might have to be forced to close the trade for a loss when I know that if I can hold on to it till Friday, it's going to be a winner, because 42.70 is hard to be reached. But it could go up 300 points. It could go up to 3,600, 3,800, and my strike would still be a winner. But because it went up, my maintenance excess goes up, and maybe I don't have enough maintenance excess. I saw that if it was 300 points away from my 42.70 strike, my maintenance excess would go up to 33,000. So that part scared me. So definitely this was my missed opportunity. I actually put in the order and canceled it. I did have another opportunity, but I didn't send an order on the other one. So I don't feel so bad about the other one because I didn't do it or wasn't thinking about it that much. But the Amazon trade, I was definitely thinking about it and almost did it. The other one was Tesla. Now Tesla, same thing. Tesla does scare me a bit because Tesla has the potential to move like crazy. So that one I don't feel as bad because I don't think I was going to do it because Tesla's a little crazy. I was going to sell a 2,500 strike when Tesla was trading at 1,700 on Monday. I was going to sell the 2,500 strike for $17. It was trading for $17. As you can see right now, it's trading for $2. So for $17, that's $1,700 that I would have collected, and I would have been able to close it today if I held onto the trade. Would have been able to close it for $200. So I would have made a $1,500 US profit in 2 days. But most likely, I would have closed it the same day. And I think yesterday was trading at around $5. End of day was trading at around $5. So this would have been a $1,200 profit if I had sold this naked call. Now I have about, I think, 44,000 maintenance excess in my margin account. So I do have enough capital to place these trades, but for some reason it still scares me. And as you can see from the broker, it also has a 99.99% chance of winning. And actually, if I want, I could still place this trade. I could still do this trade and collect $200. It's not bad, $200 in 1 week. And I just have to wait till Friday. And as long as Tesla stays below 2,500, I keep the $245. And in fact, let's see what the maintenance excess is for this right now. What's the capital required? So yeah, the capital required for this one is about 15,000 US. So I would be able to place this trade. I do have the capital to place this trade. Now it's just a matter if can Tesla jump to 7,000 like people are saying, because it's going to be part of the S&P 500. Who knows? It has earnings next week, so it shouldn't be affected by earnings. But Tesla can move hard even outside earnings. I think last week it went up 30%, and on Monday it was up 15%. So anything's possible with Tesla. But definitely Amazon. I was definitely leaning more towards Amazon. And I do feel bad not placing it because I think that was easy money, $700 just to make sure. $700 as long as Amazon stays below 42.70 by Friday. I think that's considered easy money. Now, if I go back to Amazon, maybe I don't play the 42.70 anymore because there's no more value in it, but maybe I can play a strike a little bit closer if I want. If I can go for a call that I was looking at the 42.70, what if I play maybe the 4,000 strike on Amazon? If we look at the 4,000 call, I mean, according to the broker, it still has a 99.99% chance of winning. The 4,000 call, I can get about $130. Maybe if I get closer, at the 3,900 call, I can get about $165. So there's still opportunity, but I definitely feel like I missed out on Monday's opportunity because it was $7 and it was at the 42.70 strike. So it was really far. I might wait till Thursday, end of day, because then there's only 1 day for expiration, and just see what's the highest strike I can collect a decent premium from, and then just sell that, and then I would just have 1 day to deal with. From Thursday night to Friday morning, there's going to be a big time decay. So as long as Amazon doesn't go above that strike that I sell at, then that premium will be mine. So for example, Amazon's at 30.81. Maybe I could sell the 3,300 strike for Friday, but I'll do it on Thursday with just 1 day to go. So right now the 3,300 is at $9.50, or between 9 and 15. So there's a lot of premium left at the 3,300 strike, but if I wait till Thursday, maybe I can place that trade. And Amazon was trading at 3,300 on Monday, so it has the possibility to reach it again on Friday. So I'd definitely go a little bit higher, but basically I would try to hold it for just 1 overnight. Now here is another missed opportunity. I started doing straddles for earnings. So JP Morgan had earnings yesterday or this morning before market open. So that means yesterday I was supposed to sell the 98 straddle, and I was going to collect about $5.75. So that's $575. Right now you could see the straddle next day is worth $335. So could have been an easy $200 profit as well. But obviously there's unlimited loss with the straddle if JP Morgan opens outside the $5 that I collected. So if it opens outside $98 plus 5 or $98 minus 5, I start losing $100 per every dollar it's trading at far. For every dollar it's trading higher or lower from those break-even points. So if it's trading at 105, for example, then I will lose about $200. If it's trading at 110, I will lose about $700. So the risk or the loss potential is unlimited. But if you think about it logically, what are the chances that it moves this much points? It's still possible, but it's unlikely, but still possible. And that small probability is what's scary with the naked options. But just want to talk about missed opportunities, trades that I normally make or was going to make, but for some reason just didn't feel comfortable. If you saw my last video, I feel like I lost my confidence a bit, and I'd rather just stay away for a bit until I'm convinced on the strategy that I want to take. So UNH as well had earnings today, so it's going to be tomorrow actually before market open, but today was a chance to sell the straddle. And if I look at UNH straddle, so it closed the day at around 310, and you can see the straddle is trading at around $13. So we'll have to see tomorrow what the 310 straddle is trading at. So could have sold it for 13. We'll see tomorrow if I have to buy it, how much I would have bought it for, and if it was a profitable trade or not. And Goldman Sachs as well has earnings tomorrow before market open. So 216 it closed at. Would have collected about $10 or $11. So we'll see tomorrow what that straddle is worth. And the other thing I could have done is probably could have just sold a naked put instead. So instead of selling the straddle, because there's more risk with the straddle, I could have sold an out of the money naked put. So it's at 216, probably could have sold the 205 strike, collect $146, $157. But if it drops, then it becomes problematic. But most of the time, stocks go up, or if they drop, they don't drop by that much. But it's still risky because it could drop by a lot, and then I would end up losing an unknown amount. Same thing for UNH. I could have sold the naked put on UNH, and I would have collected out of the money probably. I would have collected about, this one would have been a good one actually. Could have collected $300 on the 300 strike. It has a 17% chance of being a loser, but of course, with earnings, it can destroy these probabilities. So these are other opportunities I think I will miss out. I'll find out tomorrow. But I have a pretty good chance that these naked puts would have been good winners. I'm not too sure about the straddles, but I'm pretty sure these naked puts would have been a good winner. We'll see tomorrow. So I sold my regular SPY put spread that I normally do on Monday, Wednesday, Friday. The one that I sold on Friday, I actually closed it on Monday for 20 cents. So the one I sold for 70 cents on Friday, closed it for 20 cents on Monday. It had a July 17 expiration. So I closed it early, made a 50-cent profit times 2 contracts. So that's $100 USD profit. And then I opened another one on Monday with a 313 strike. So it looked good on Monday because SPY went to 322. I collected 70 cents and I was able to close it actually the same day for about 58 cents. Now, I didn't close it for 58 cents, but today when the SPY dropped to 312, I definitely regretted not closing it. But I think right now we're back up again, and it's showing a small profit. It's showing a small loss. So I sold it for 70. It's trading for about 76 cents right now. So it's showing a small loss. And Spotify, I sold a put spread on Spotify at a 265 short strike. So I started off with a put spread, and then today Spotify was trading below 250. So so I do what I normally do to hedge against the put spread is I sell a call spread. I sold the call spread at the same strike as the 265 as my short put because this expires this Friday. Collected $1. So right now my total credit is about $1.91, but right now I can close the trade for $4.85. So I'm losing money on this one for sure. But so what I need right now from Spotify is to trade or to close on Friday as close as possible to 265, just so I can lose less. I only collected $1.91. My max loss would be $3 here, $3.09. That would be my max loss on this trade if Spotify is trading above 270 or below 260. I sold that call spread when Spotify was trading at 252 about. So I had to take action. I couldn't just leave my put spread like that without taking action. So this looks like it's going to be a loser unless I get really lucky and Spotify trades very close to 265 come Friday. Now, if I was doing a naked put instead of a put spread, I would have used a much further strike. I would have used a 240 strike or maybe even 235 strike. So it would have made the trade safer. So an advantage of going naked is you actually have less risk because the trade is safer. But because I'm doing a spread, I had to be this close in order to collect something decent. I collected 85 cents to begin with. But the advantage of a spread is that if the market drops like crazy, there's no surprises. I don't lose an unlimited amount. I know what my max loss is, and I can actually decrease it a bit by selling a call spread. So it's less stressful. I can control it more, but you don't collect as much and you don't go as far. So that's the downside. In my RSP, I continued selling out of the money covered calls on my IWM position. So you could see here, IWM is trading on 141. I sold the 148.5 call, and I collected 36 cents. So every week I'm just collecting premiums from selling call options against my position on IWM. So in my RESP, I was a little bit hesitant. So last week I sold everything. I sold Dell, I sold MasterCard, because I don't know what to do anymore. But I kind of wanted to get into Intel, and I was hesitant. Should I buy Intel and keep it forever, keep the dividends, try to collect capital appreciation, but then sell out of the money covered calls on Intel every week? And I could have collected about $30 if I did that this week at a 60 strike. But instead, what I did is I bought Intel at 57.72, and I sold a call option at $58, collected 77 cents. So my cost to get into this trade is this minus this. So 57.72 minus 77 cents. So my cost is about $57. And my max selling price is $58, as long as Intel is trading above 58 come July 17. And it's already trading at 58.98. So it has a good chance of being a profitable trade. I'll make an easy $100 US on this trade. But what I could do is I could roll the call option. So I could keep the shares and just buy back the call option and then sell the next week's call option at the same strike and collect maybe $1.20 maybe. Here, let's try create rollover order. No, I don't normally use IQ Edge, but for this video, I just wanted to show the probability. So I thought I'd use IQ Edge. So I'd buy back the 58 call and then I'd sell the 58 call as well, July 24th. And you could see that I can collect maybe another $1 if I do that right now. I'm not going to do that right now. But if I do that on Friday, I could probably collect more. So collected $1 this week, would collect $1 again for the next week. So that's $2 on a $57 capital. So it's a good return on investment. I thought I would do that. I thought I'd milk it as much as I can, collect as much premiums as I can from this trade. And if I have to get out, then I'll just get out, get my capital back, and then I look for something else. But I'm still hesitant. I'm not sure if I want to take the buy and hold approach in my RESP and just sell out of the money covered calls to increase the dividend amount, or if I should just sell at the money covered call as much as I can until I can't anymore, and then just take my capital and then look for something else to sell at the money covered calls on as much as I can, and then get my capital back and repeat the process. So I'm still hesitant. I don't know. I'm not too sure which strategy to follow or which approach to follow, but I did something with Intel and I just wanted to share it. So yeah, so these were my missed opportunities and my trades this week. So if you have any questions, leave them in the comment section below. And like always, if you can open an account with Questrade to trade on the stock market, use one of my referral codes below. One of them gives you up to $250 back depending on your deposit, and the other one gives you $50 in free trades regardless of your deposit. And if you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.